My guest today is Ty Sagalow, founder of Innovation Insurance Group. Ty has held various underwriting and product development positions at AIG over his 25-year career there and served as Chief Innovation Officer at Zurich North America and Tower Group. Ty was a founding member of Lemonade Group and served as Lemonade's Chief Insurance Officer. Ty wrote a book about that experience called The Making of Lemonade, which is the subject of today's show. Ty, welcome.
Thank you, David. Good. Thank you for having me.
So one thing that strikes me about your bio, actually, is how much experience you had in insurance innovation before you even started in the insurtech business, or at least as we think of it today, the tech startup business with Lemonade. So I'm wondering if you could start maybe with talking about that part of your history. In particular, if there are any stories of failure or successes even from your prior career that was in your mind with Lemonade. Now that you're starting a company, what are some things that you wanted to make sure you were thinking about the whole time?
So I spent my entire career prior to Lemonade, 33 years in the traditional insurance industry. And although I've had a lot of jobs and a lot of titles during that time, they all dealt with innovation of one sort or another. And I thought I was doing pretty cool stuff. At AIG, I was the Chief Innovation Officer for a few years. And even before that, I led a team that invented Y2K insurance and cyber insurance and the modern form of directors and officers liability insurance. So, a lot of fun. And I learned a great deal of things during that period of time and a number of lessons, many of which ended up being absolutely untrue.
Huh.
But
what? What's the most untrue one?
Well, so when I was doing product development and even teaching and writing books and whatnot, I would tell folks that the goal is to create out of the box the perfect product, one that never needs to be changed from the moment you launch it,
right?
With an understanding, of course, that you'll never reach that goal, but that's the goal nevertheless. Of course, in InsurTech and at Lemonade, I learned the idea of MVP. And when I first heard about MVP, minimally viable product, I never heard of that. I was trying to figure out why most valuable player had anything to do with what we were doing in Lemonade. And then it was explained to me that minimally viable product means that you create just the minimum that meets the needs of really first movers, just enough to get something out into the market that you know and intend to be imperfect, and then you change it over time. And this confused me a great deal, and I remember saying to Shai Wittlinger, one of the co-founders of Lemonade, I said, let me see if I get this straight. We are trying to be imperfect. We're not going to be imperfect by accident. And that was a little bizarre to me at the time. And the other thing that I was taught, and I taught others during my years in innovation in traditional insurance, is that you try to figure out what your clients want, and then you send something out into the market. And you hope it works. And if it doesn't work, then you bring it back and you look at it and you change it and you send it out again in an improved form. In InsurTech, I learned about something called A/B testing. And A/B testing is you send out multiple versions of something to see which your clients like better. This also confused me because when I was first told about A/B testing, I responded with, oh, I understand that. We do A, and if A doesn't work, then we try B. And I was told, no, Ty. We try B no matter what, even if A is working fine. And this confused me, because why try something new if the thing you're trying seems to work? But what both these concepts of A/B testing and MVP stand for is don't be arrogant that you think you know the product that your clients will want. You really have no clue. They are the deciding points. Send out the minimum that you know isn't perfect, because only through their feedback will you make it better. Try multiple things and see which they like better. It's, in one of my employers, we called it customer-focused innovation. But the traditional insurance industry tends to use that as a marketing phrase. When in InsurTech, it is in the DNA of an insurtech company.
So in a traditional insurance product development process, what does failure look like? How do they fail? What is it? Is it failure where nobody buys it, or is it failure when it's I don't know. I guess when it's illegal, that can happen. What are the ways in which products fail?
There are many ways in which products can fail. Of course, a product can fail because nobody buys it.
Yeah, somebody wants it.
Great idea. People said they were going to buy it, and then when you launch it, nobody buys it.
Because you do like a customer survey or a focus group or something like that.
I had a spectacular product one time. It was great. It insured missed hand singles in the Chicago Commodities Exchange.
Interesting.
So you know how people in the Chicago Commodities Exchange, they do buy-sale transactions through hand singles because it's so noisy you can't hear what people are saying.
Yeah.
And sometimes the hand singles get mismatched, and it's called an out trade.
You thought it was a buy and it's actually a sell or something.
Exactly. And so we did a focus group of the biggest traders on the Chicago Commodity Exchange, and they all said this is something that worries us, and if you are able to create an insurance product for it, we'll buy it. And my partner at the time was the head actuary at National Union, and he said, give me the data and I'll tell you the price. And of course, the Chicago Commodity Exchange had years and years and years of data on these out trades. So we were able to figure it out.
Yeah.
And the chairman of the exchange really liked the idea. So he, in an unprecedented manner, gave us a room right on the floor. So we had access to the clients. Yeah. We had a product that they told us, they would buy based upon focus groups. Yeah. We had the sponsorship of the head trader.
Sure.
And we had an actuarially defined product that would make money.
Yeah.
Did not sell one.
Wow.
And that's because we forgot a fundamental thing about product development, which is you really have to know your customer. And these were traders. So the concept of buying insurance that they hoped they would never need was foreign to them. They kept on asking, well, what's my ROI on my premium? What are the odds of me getting more in losses paid than the premium that I've paid? And so it was a spectacular failure. So you can have failures. Of course, you learn a lot more from failures than you do successes. You can have failures based upon the fact that nobody buys the thing. That happens a lot. And if you're an insurance company, you're supposed to make money. So you can have failures when losses exceed premium. Now, hopefully, that's just a
temporary
speed
thing.
bump.
You can figure it out.
Because you can figure it out and either change the price or change the terms or do both.
Yeah. Tell me another story. I love that story about the trade. What's another cool product you might have come up with? AIG or Zurich or anywhere else you work?
Well, I'll give you a success story.
Okay, sure, yeah.
And it wasn't because it made a lot of money. See, that's the flip side, which is what makes it success. And you would think, well, you have to make a lot of money. But that's not necessarily true. I mean, you shouldn't lose money. But the new product that I remember the most in all my years was not the one that had the most profit and not the one that had the highest top line, but the one that did something important to society. There are hundreds of thousands of children who die in Africa as a result of malaria. And there's a very simple fix, which is getting malaria nets. Mm-hmm. But there are only 3 manufacturers of malaria nets, and they don't manufacture the nets until they get the grant from the UN. And that's a political process that takes years. So we created a surety bond product that would guarantee the payment to the manufacturers of malaria nets during the UN process. That resulted in hundreds of nets being created years before they normally would, and savings of what I was told was tens of thousands of lives of children in Africa.
Because they got the nets sooner than they otherwise would have.
Correct.
Right. Because you dealt with the risk of the UN delaying or denying the application, I suppose.
Yes.
Right.
And so it was sort of political risk insurance.
Yeah, right.
But the amount of money at risk was nothing for AIG.
Yeah, sure.
And it was my first example of trying to create a product that makes the world a better place, which, of course, ultimately led me to Lemonade.
Mm-hmm. Well, let's let's come to that in a second. How do you get into this product development kind of role? I mean, it sounds pretty unique. Tell me when did you begin your innovation officer career at AIG? What was the transition? How did that happen? What were you doing before?
You know, it was interesting because I'm a lawyer by training.
Okay.
So I started AIG as a litigator,
Okay.
which I hated, and I wasn't very good at it. And then I moved over to National Union to learn directors and officers liability insurance
Okay. As an underwriter
as a deputy general counsel. So first
Okay.
I was on the lawyer side.
Okay.
And one of the jobs of a lawyer at National Union was to help create rewrites, refreshes. And because of AIG's culture, part of that process was thinking about doing something different, thinking about something new.
Yes.
Back then, we never created a new version of an insurance product without also containing some features that the industry had never heard of. And I immediately realized that for me, that was the fun part.
Yep.
So whatever I did, I later became the chief underwriting officer of AIG. Of National Union, and I was always naturally thinking about doing new things that no one else has ever thought of. And luckily, I picked a carrier that had that culture, and eventually that led to creating Y2K insurance and cyber insurance, and then ultimately being chief innovation officer for AIG.
So fast forwarding now to the Lemonade part of the story. Before you met Dan Schreiber, you must have been pitched by startups before that, right? I mean, you had a great resume for them. I can tell why they were attracted to you, why all these folks were attracted to you. What were you doing?
So, I went on my own in 2012.
Okay.
And created a company logically called Innovation Insurance Group. And I hung out my shingle saying I will help people innovate.
Yep.
And a lot of that was helping, carriers rewrite products like I did when I worked for them, and helping brokers. But the really fun part was helping entrepreneurs.
Okay.
And so an entrepreneur would come to me and say they want an insurance policy in order to make their business work better.
Yep.
But the insurance policy that they want doesn't exist. And sometimes they would go to a broker, and the broker would say, we don't really do that for a living, but we know a guy. Mm-hmm. And then, eventually people just found me directly. So, for example, I had a client that wanted to create a website that would sell collectibles. And, of course, there's a lot of competition in that, eBay being a main competitor. And so one of the value propositions that he wanted was that everything he would sell would be guaranteed to be authentic. There's a lot of fake and inauthenticity in collectibles these days.
Yep.
So he wanted to guarantee that to give a guarantee that it would be not fake, that it would be real. And he wanted that guarantee to be insured by Lloyd's of London.
Okay.
So he went to a major broker and said, I want collectible authenticity insurance.
Okay.
And they said, it doesn't exist. And he said, well, you're XYZ, create it.
Yeah.
Create it.
Yeah.
And they said, yeah, not what we do for a living, but we know a guy. So he came to me, and eventually I did create the first, and I think the only, collectible authenticity insurance through Lloyd's of London. And so I did that 2 or 3 times for various entrepreneurs. And so I would get these phone calls sort of on a regular basis.
And your main thing that you would bring to the table then would be a policy form? Like, what is the output of your product?
It was everything. So
Okay.
so putting on my chief underwriting hat,
Okay.
I would write up the rating plan. I would figure out, working with actuaries
okay.
to the extent you needed to, what the right premium was. Of course, I would draft the policy. I would do the pitch deck. I would do a demand analysis.
How do you come up with a premium for a new product?
It's
never been done before.
Yeah.
What do you do?
It's fun. It's fun. And it's as much of an art as it is
Sure.
a science. So little known secret up to now, where I'm now going to announce it to the world.
Okay.
But that's okay, because it happened 20 years ago.
You heard it here
so
first.
we were trying to create cyber insurance,
Okay.
and back in 2000. And so we wanted to cover the business interruption loss
Sure.
of a distributed denial of service attack.
Very topical now, isn't it?
And, DDoS attacks were not that common back then. So there was insufficient frequency information to help an actuary.
Yep.
And, of course, there was no really lost data to even figure severity.
Yep.
So we had to make certain assumptions, and we made certain analogies. So first, on severity, we assumed that a client would be able to prove the amount of lost income in the same way they would if there was a fire.
Okay.
So we had to then decide, well, how long would this fire last?
Okay.
And then we had to decide how often it was. Mm-hmm. And we talked to a number of CTOs and CIOs and just made an assumption on how a denial of service attack would compare to having a fire, both in terms of length of recovery time as well as frequency. And, of course, it was a complete guess, based upon some input.
Educated guess. Yep.
But a guess nevertheless, with an understanding that you would watch your losses and you would watch your product and do surplus lines, obviously, and then adjust it as needed.
Yeah. Yeah. So that worked, that process?
Yeah. I mean, I can say it now because it was 20 years ago, but
Sure.
we got up to $100 million in sales at 11% loss ratio, which is something I'm still proud of 20 years later.
Wow, that's cool. So then you get a call one day from Dan Schreiber. Tell me about that.
So here I am. I'm at my desk at Two World Financial Center, and I get a phone call from an entrepreneur, not unlike any other phone call from an entrepreneur, except this guy had a nice British accent. And he said he was calling from Israel, and he found my name because he Googled innovation and insurance, and even apparently from Israel in 2015, if you Googled innovation and insurance, I would be above the fold. I really owe those guys flowers. And he asked to see me for 2 hours to talk about an idea for the sharing economy, which is something that I had been following for some time.
Okay, this is Uber,
Airbnb, and things of that nature. And I've been following that from an insurance perspective for some time.
What do you think about that from an insurance perspective? What was your analysis of that at the time? I mean, segueing, you're a little bit, not segueing at all. We're changing the subject for a second, but...
I thought at the time that it was a cool way to, for the economy, cool direction for the economy to go into. Mm-hmm. And I thought it wasn't going to go away, but I wasn't 100% sure. Mm-hmm. Now, fast forwarding, 7 years later, obviously the sharing economy is here to stay.
Sure.
And one of the things that you learn in product development is that the most sustainable products arise out of substantial changes in society.
Right. Yep.
And so there is a substantial change in society from a belief in the statements and the capabilities of the expert, and then compare that to wisdom of the crowd. Mm-hmm. So wisdom of the crowd is a phenomenon that is hitting all areas of society, where we trust the views of hundreds or thousands of people like us more than the view of the so-called professional.
Yep.
So you trust 5 stars, a 5-star rating of an Uber driver, more than you trust a Hilton Hotels commercial. And same thing for Airbnb.
Yeah.
And again, the analogy between Airbnb and Hilton Hotels and Uber and the New York Taxing and Limousine Commission.
Yeah.
So the fact that there is an entity, a centralized entity called the New York Taxing and Limousine Commission that gives licenses and allegedly gives approvals to taxi drivers. So back in the day, before this concept of wisdom of the crowd, you would say, well, I'm going to a yellow taxi. These guys are licensed and they're evaluated and they're approved by this centralized authority called the New York Taxing and Limousine Commission. But what Wisdom of the Crowd is about is no, folks don't trust that opinion as much as they trust 1,000 people giving a 5-star rating to John Smith driving his Ford. Mm-hmm. And that phenomenon of Wisdom of the Crowd started back in 2012. And again, Bitcoins and cryptocurrency is yet another example of that.
Yeah.
And today it's firmly implanted. So those are the sort of trends I was looking at before Daniel gave me the call. He said he wanted to talk to me about something like that in the insurance area.
Okay. Got your attention.
And he wanted to see me for 2 hours. So I said I would give him an hour because it's not billable. So,
Yeah.
And he came in 2 weeks thereafter. We spoke for about an hour. Very, very impressive individual, immediately. And he only knew 3 things. He wanted to create a company called Lemonade.
Okay.
He wanted it to be in the insurance industry. Now, back then, he didn't know the difference between an insurance broker and an insurance carrier.
Mm-hmm. We'll come to that.
And he wanted to have something to do with the community.
Okay. That's pretty broad.
Pretty broad. And at the end of the hour, he asked me whether I would be willing, within the next 3 weeks, when you deal with Israeli entrepreneurs, you got to move fast. So
Surprised he gave you that much time.
Right? Exactly. 3 weeks, a huge amount of time, to fly down to Israel and meet him and his partner, Shai Wittinger, who is the CEO of a fabulous Israeli-based company called Fiverr that went public just a couple months ago, I think, to talk to them about this new idea they had. And so I agreed, and 3 weeks later I was on United Airlines going to Tel Aviv and Jerusalem.
Okay. And you took that because of the force of the personality and the charisma of Dan Schreiber. I mean, at that point, he didn't have a whole lot to go on, right?
That and a free trip to Israel.
Okay, right. They're paying for you to go to Israel.
Yeah, so
and it's a place you wanted to go.
I'm Jewish, and I'm somewhat ashamed of the fact that I've never been to Israel. So,
Okay. Take that box.
It was, yes, I was interested in the idea, and I was equally interested in a free trip to Israel.
Yeah. So who's on the team at that point? You have Dan, you have Shai. Who else do you have?
That's it. I mean, I was employee number 3.
Right.
So it was Daniel Schreiber, who was the president of PowerMat, and also the CMO of SanDisk.
Okay.
And Shai Wittinger, who's the CEO of Fiverr, and me.
Right.
And there was
What'd you talk about there? What? These guys are software guys, I guess. I mean, certainly Shai is, but Dan as well. Is he a software?
He's I would call him a technology executive.
Okay.
A great technology company executive. And probably subject matter expertise would be marketing. Mm-hmm. And Shai, equally great technology company executive with a subject matter expertise of coding.
Okay. And so during that trip, I suppose you guys do some brainstorming sessions, and then you eventually come up with some version of the company which was launched?
Yeah, I mean, what we did, we spent 3 days together.
Okay.
So 10 hours a day, 3
Wow.
days in a row, and we started off, and there's a picture of this in my book.
Yes.
Of a room with a word on the wall that said Lemonade, and then a table, and the table had a whole bunch of yellow stickies, and we would pick up a sticky, write something on it, and put it on the wall, and that's what the 3 of us did for 30 hours.
Where did the name come from? Why?
So the name originally came from that saying well known. That when life gives you lemons, what do? You make lemonade. Mm-hmm. So the concept behind Lemonade was to turn insurance from a necessary evil back to a social good, which is what insurance really was created to be back in the day. Mm-hmm. So here we are. Just a room, word Lemonade, yellow stickies. And for the next 30 hours, we would pick up a sticky, write something on it, put it on the wall.
Like what? What would you be writing on the stickies?
Well, eventually they became columns of like thoughts.
Okay.
Underwriting, claims, customer service, technology, onboarding, finance, business model, etc. And so after 30 hours of doing this, you look at the wall and it begins to look like a business model.
Okay.
It begins to look like something. And it was the beginning of what was to be Lemonade. And I remember Daniel going to me and pointing to the wall and saying, "Will this work?" And I looked at the wall and I said, "Nah, that's not going to work." And
Why not? Why wouldn't it work? What would?
and that's what he said to me. He said, "Well, why not, Ty? What's not going to work? We'll change it. What's not going to work?"
Right.
And I taught him his first lesson in insurance innovation. He obviously knows a lot about innovation, which is, I have no idea what's not going to work, but something on this wall is not going to work, and it may even be something really fundamental. And we'll just have to figure it out and change it and make something else work.
So at that point, you're committed. Are you in when you're walking onto that
Well,
plane back on United Airlines?
So I was walking out the door, not committed to anything.
Okay.
I figured I gave my 3 days and got my free trip to Israel, and I was ready to go home. And that's when they stopped me again, very Israeli, and said to me, "Here, I've known these guys for 72 hours." And they say to me, "We think you're our guy." And I say, "Well, thank you very much. What do you mean?" And he says, "We'd like you to be the company's chief insurance officer." And later on, it was determined that for regulatory reasons, it made sense for me to be CEO of the insurance subsidiary. So I was flattered, and by then I was all hyped about this company.
Okay.
You know?
Yep.
And I said, "How much money you need to raise?" Now, we had already determined it was $10 million, so I was really testing him. And he said, $10 million. I go, "Okay, how long?" He says, 12 weeks, maybe less.
Wow.
So I said to him, "Well, if you raise the $10 million, I'll work with you 1 day a week. This is the price."
While they're raising the.
While they're raising it,
Yep.
1 day a week, here's the price. At the end of 3 months, you pay me no matter what. But if you raise $10 million in 12 weeks or less, I'll be your guy. And then, of course, we work out the details and whatnot. Again, very Israeli. Let's figure it all out, turnkey. So if it happens, we don't have to do any more negotiation. And as it turned out, of course, they raised $13 million in 10 weeks.
That's amazing. Heck of an achievement. And so now,
Incredible achievement.
over that period of time, and there's a lot more detail on all this in the book, but now you're in, and now, so they raise the money. What does Lemonade have when it's raised the money in terms of, people, assets? Do you have, you have code? What do you have? What is the company?
So I think at that point in time, we had 6 people,
Yep. Okay.
which became the founding members.
Okay.
It was the 2 founders, Shai and Daniel, myself,
Yep.
and then someone from PowerMat
Okay.
called Maya Cohen for business development.
And so Maya joins after the sticky session.
After the stickies,
Okay.
and
Before
as
the funds.
and as part of
The fundraising.
as part of the fundraising.
Okay.
And then Shai brought a fabulous coder by the name of Moshe Lieberman, 26 years old, very bright, and then we had, so that's 5, and then the 6th was Dan Arlelli, who's a professor at Duke University, known for a number of things, but mostly behavioral economics, who became our first, and I think the first, industry chief behavioral officer.
Yeah.
So that's what we had. We had 6 people. Maya and I opened up a small office in WeWorks
Okay.
in the financial district.
Maya's based here, or was then. I
Yes,
guess.
and we were off to the races.
And coding through the time, like, tell me, one of the things that fascinates me about the insurtech scene, the tech startup scene generally, is that it seems to me that the software design and implementation process at tech startups is a different kind of process than you get at an insurance company. Are they doing something different, more productive, more effective? They build better software. All these things true. You were there from the very beginning. What did it look like?
All of which is true.
Okay.
And nothing against the software providers and the policy administration companies. that have been servicing insurance companies for decades and decades and decades. But it's a different mindset. And I remember before we ended up deciding to do everything ourselves, my initial recommendation was that we would create proprietary software for anything that was customer facing, but anything back office we would just buy off the shelf.
Right.
And we had a meeting with one of the major providers in this area, and they heard what we wanted to do. And they said, okay, we can do that. It will be between $2 and $3 million, and it will take 18 months to 2 years. And Shai whispered in my ear, Ty, I don't understand. I could do this for 1/10 of the price, and I can do it in 60 days.
Yeah.
What don't I understand? And I said, there's nothing you don't understand.
So
and
what's
then
the difference? What does he do that they don't do? Why don't the big tech companies or the vendors hire a bunch of these people and then change
It's the same problem as why aren't big established insurance companies going at the speed of insurtech companies? There is a difference in mindset.
What is the different mindset?
Well,
Can you tell me more about that?
So if you are a large technology provider, you have now a base software that you have been selling for decades,
right,
and you have many, many, many clients. And so the natural tendency is to make incremental improvements, right? We'll twist this, we'll twist that, but we really want to sell what we have to as many people as possible. And now we have a big infrastructure and we have a lot of employees. And that's very different than two guys in a garage. It's actually simpler to change something 1,000-fold than to make it 10-fold better.
Mm-hmm.
To make it 10-fold better, you have to begin with what it has, and with all the restraints of what it has. If you want to create a new process that's 1,000 times fold better, you got to start from the very beginning. Start completely from scratch, and that takes a different type of way of looking at things.
Mm-hmm.
And I'll give you one of my best examples. So, we were at the tail end of almost getting our license from New York, and they wanted to make a number of changes, a dozen changes. So I call up Moshe, and I say, Moshe, we need to make a whole bunch of changes. So I start rattling off these changes as fast as I can, and I'm hearing clicking noises in the background. And at the end of my dozen changes that I'm saying as quickly as I can, I say to Moshe, do you got that? And he says, what do you mean, Ty? And I say, well, have you taken note of everything that I've just told you we have to change? And he said, no. And I said, Moshe, why the hell not? He says, well, I made the changes as you were saying them. Should I have not done that? Should I undo the changes? And I said, Moshe, no, you don't have to undo the changes. And that's the last time I ever questioned Moshe Lieberman.
Mm-hmm.
If I was dealing with a traditional insurance software provider, I would have to send that in email. It would then prompt a meeting, which would prompt a number of emails, which would prompt then a number of meetings, and maybe 6 months later I would have it. Maybe.
Yeah. Unbelievable. I mean, it's just so it's amazing to me how different it is. And is it that they're risk averse? Is it that they're maybe Moshe's just, I mean, he's going to be more intelligent than the average anything, right? Because he's clearly a brilliant individual. Is that enough? Is he motivated, passionate?
It's all of the above. He's motivated, he's passionate, he's young, and he's in an environment that speed is king.
Yeah, culture.
It's a huge difference in culture.
Yeah. And so, in that culture, it's interesting to me. That's not just a culture that's different from the insurance software business. That's a culture that's kind of different from the insurance business as well, right? And so, here you are trying to create, and this is your role as the insurance guy, chief insurance officer, to build an insurance infrastructure capability inside of this different culture, right? Because the culture that the company starts with is a software culture, this startup culture. Clash? Did they clash?
Oh, huge. And so my first job, imagine, right?
Yeah.
So it's me and Maya, And we have $13 million in the bank, half of which came from Sequoia Capital. So those guys don't
Big
fool
time.
around.
Yeah.
Right? They funded 20% of the NASDAQ. They're big shots. And, we have nothing. So I have to build an insurance company.
Yeah.
Literally from scratch. Now, luckily, I don't have to worry about customer service. I don't have to worry about business development. I certainly don't have to worry about operations and technology, but I have to build everything else.
Yep.
I have to build underwriting. I have to build claims. I have to build finance. I have to build legal, right? And I went to, again, the normal insurance executive recruiters who said to me, Ty, we're happy to help you do all this. You know we are. It'll be $100,000 up front, and it will take about a year.
Yeah.
So I didn't have $100,000 I wanted to pay them, and I gave myself 4 months.
Yeah, you definitely didn't have a year.
And I didn't have a year. So we had a saying back then that we were looking for people that were going through a midlife crisis because I wanted senior insurance executives with 20 plus years of experience that wanted to abandon corporate America just like I did, join a startup, which might not exist a year later, for 1/3 of the salary they were making now. Now, they'd get stock options, so if everything worked out well, as it ended up working out well, they would make a lot more money. But, of course, you don't know that at the time. And so we were very lucky that we found claims and finance and underwriting and even legal of people who were emotionally and financially in a position to say, you know what?
Sure.
I've had it with this. I want to try something new.
Yeah. They can take a risk.
And I can take a risk, and I can afford to take a risk.
Yeah. Not for everybody. You don't just go grab people off the off the street. So can you think of an example? So, I mean, come back to this original idea right at the beginning of our conversation where you're talking about the adaptability and the need to make changes. Can you think of an example when, let's say, the insurance culture clashed with, let's say, the Silicon Valley, although they're not from the Valley, they're obviously an Israel culture, and maybe can you think of an example when the insurance culture won, and maybe an example when the software culture won?
Yeah, I'll give you an example of each. Just ones that are hitting my mind. So the one where the insurance won. So the CFO was asking for a report on past premiums.
Okay.
And the technology team said, "What do you mean? When something happens, we just we overwrite the past.
We don't care what we would have charged for
we
a year ago.
We don't care what happened.
Yeah.
Last quarter. We're concentrating on this quarter." And literally, there was no records of past activity. And so the CFO said, "Yeah, we kind of have to have that. We're a regulated entity." And they didn't understand, and it came back and forth. But eventually, we did win out, of course.
Yeah.
And we went backwards and fixed everything. But it was that just fundamental disconnect that anyone in insurance would say, "What?
Obviously, you need to do that. Yeah.
What are you talking about?" Right? We're just talking about actuaries. It's like it's like a real insult to actuaries. The past doesn't exist.
Yeah, right.
And then we had another example where I got to be a little careful here. Okay, here's not the best example that comes to my mind, but one that won't get me in trouble. So the insurance has a concept of seasoning. Right? And what seasoning means is that if you are a new insurance company, you start off with state number one, your domestic state, and then you have to hang out there and work there and do business there for 3 years. You have to be seasoned. And then only after that can you venture into other states. And it's a firm rule in the insurance regulatory environment and has been around for decades and decades and decades. Well, that is contrary to the idea of a technology company. The idea of a technology company is you don't have to have boots in the ground, so there's no restraint from you being available to everyone. You should be available worldwide on day one.
No marginal cost.
Right? No marginal cost. And so this was head on, the concept, the essence of a technology company being available to everyone, everywhere, right at the beginning, and this concept of seasoning. A direct clash. And so we looked at the concept of seasoning and looked at it from the point of view of a technology company trying to create something new. And eventually was able to make the argument successfully everywhere that the rule of seasoning should not apply to lemonade because we were serving a market in a way that had never been served in the past. And as far as I know, that interpretation of what was the underserved market had never been done in the history of the insurance industry. It was a direct creation of the technology culture. And we eventually convinced everyone, all the insurance regulators in the United States that were licensed, and now we're licensed in, I think, about 80% of America from a population point of view, that yes, we deserve seasoning to be waived because of a way that a technology views society.
And so, of course, you needed to obey those or at least confront those regulations on seasoning because you were an insurance company, right? Which is another very important decision that the team made, was to actually launch an insurance carrier versus an MGA or agency. Maybe talk about that decision. How was that made? Why'd you go that way? Was it the right decision? Probably certainly looks okay now.
Well, it was a major decision.
Yeah.
But strangely enough, it was a major decision that we made almost instantaneously.
Okay.
So there are pros and cons of if you are an insurtech company and you want to be something other than a technology service provider.
Yeah.
So your other two choices is an insurance broker and an insurance company. And there are pros and cons. Almost every insurtech company, almost everybody, decides to be an insurance broker.
Yes.
And the reason for it is it's a lot cheaper. You don't need $10, $12 million. You need much, much, much less. You're not taking balance sheet risk.
No seasoning.
And there's no seasoning requirement. And you're less regulated. A lot of reasons to do it. And everybody does it. We decided almost from the beginning that we wanted to be an insurance company. And the reason for that, and it became probably the most important decision that we made, and the reason for that is that we did not want to put our fate in the hands of another. When you're a insurance broker, even if you're an MGA, and I am an MGA today on a couple of my businesses, so it's not that I'm against the model.
Yep.
But the problem with the model is that you are putting your fate in the hands of the insurance carrier that's giving you paper. And more to the point, you're putting your hands into your rabbis at the insurance company, that may be one or two people. And if they leave, you could be out on the street. If you're Lemonade or you're an insurance tech company and you believe in insurtech company and you believe in A/B testing and MVP, you want to rapidly change your product, rapidly come up with new versions, and you don't want to be hamstrung into having to get the okay from an insurance company. So we decided straight on to take the path, the road less taken, do what is hard, not as what easy. And I think, obviously, it turned out extremely well. And it continues to be the minority choice by InsurTech today. But it was the right choice for us.
Any strategic pivots in the history of the company? Was there anything that you guys, did you ever go with B instead of A or over something? Was there something that you changed about what you thought was going to work at the beginning and then you wound up taking a different direction?
Yeah, I mean, there's one that comes to mind, which is being a technology company. Well, the first thought was we didn't want an 800 number. We didn't want any ability to someone to call us. You had a question and use our chat box.
Yeah, sure.
Maybe
use software.
If you have a slow day, use email.
Yeah.
Right?
Yeah.
But an 800 number, no, why would we want an 800 number? And we had to have an 800 number because both Demotech, our rating agency, as well as the New York State Department of Financial Services, required us. So we reluctantly had this 800 number that we assumed, no one would call.
Yeah.
What we found out was even millennials sometimes want to talk to a person. Not most of the time, but if you have a big enough target audience, a small percentage of a big number is still a big number.
Yeah.
And so we had to pivot and create a customer service department that rapidly became really 1/3 of the employees we had in New York. But it was not the original concept at all.
How about something that? So here's a different way of thinking about this. This is a company that is selling a product that already exists in the marketplace. To the point you were making earlier about the innovation or the underserved market being an interesting argument, right? What about Lemonade's process is different than what came before it?
So there are 3 fundamental value propositions of Lemonade.
Okay.
And they all work together in, I'll call it a sweet and delightful manner. One, of course, is cutting-edge technology.
Yep.
The use of chatbots instead of applications, speed, friendliness. You apply for the insurance in less than 3 minutes. Probably even more impressive, you submit your claim in 90 seconds. And you can submit your claim, you only can submit a claim on your phone. There is no fax machine, there is no paper. You can't even do it online. You can only do it on the phone. And again, you do it through a chat bot. And part of it is just videotaping what happened to you. So a very unique interface with our customers. Second, of course, is the elimination of the inherent conflict of interest. That's what most intrigued me, because I'm a history guy, right? So insurance was supposed to be a social good. It goes back to helping ship captains get to the new world by ship captains pulling their resources and taking a risk.
Mutualizing.
There was no centralized insurance company. There was it was us. And somewhere along the line, it changed from us to we versus them. And it developed into a model where for every dollar not paid in a claim is another dollar of profit to the insurance carrier. It's one of the only model I'm aware of that inherent in the business model of the company or the industry is an inherent conflict of interest between the provider of the service and the recipient. And so the second thing we did is turn insurance into a SaaS model, software as a service. So we charge 25%, it's changed over time, I think now it's 25%, of every premium as a fee. And that's what we use to run the insurance company and hopefully make a profit. The other 75 cents, more or less, is used for things that the policyholders need us to do for them, or it goes directly back to the community. So we developed this concept. Originally, it was thought of as peer-to-peer insurance. We don't use that phrase anymore. It became very popular at the beginning. We were called the Uber of insurance. And the reason why that became popular at the beginning is that it helped explain what we do with our policyholders.
Sure.
That at the end of the onboarding process, you're given 15 charities to choose from. And you choose the charity that's closest to your heart. And then we group all the folks that chose the same charity and made them into a virtual cohort. And then we look at the profitability of that cohort, just that cohort. And if that cohort is profitable at the end of the year, which we define as a loss ratio less than 40%, then the excess, the unearned monies, if you will, the difference between their actual loss ratio and 40%, is then given back to the cohort. So we don't get one dime more. There's no profit sharing as it is in reciprocals and whatnot. It's not like a mutual where there's one big cohort, right? We make separate little cohorts. And we don't make one penny by denying a claim. So the second value proposition is getting rid of the conflict of interest. And the way we did it, as I just described, leads to the third value proposition, which is helping community. So we can't take these unearned money That's how we get rid of the conflict of interest by not taking it. Who do we give it to? We give it to the charity chosen by the cohort, helping that community. So those three value propositions are very, very hard to duplicate by a traditional legacy insurance company. And there is, to the best of my knowledge, no other insurance company existing today that has those three attributes.
How do you know? So how do you know innovation's working, right? So those last two pieces, they exist in a version as mutual insurance companies, right? A version of it, right? And you make some comments in the book. I'm interested to hear your thoughts on the way the mutual model exists and is represented today. But innovating on stuff like that, how do you know it's working? Right? I mean, is there a way to measure success there?
Eventually it is.
Okay.
I mean, so John Peters, our chief insurance officer, right?
Yeah.
And so he has to make decisions based upon actuarial studies
Right.
and reserving and whatnot. And at the beginning, you don't have enough data, so you just reserve based upon industry standards.
Yep.
But over time, you use more of your own data, and
Right.
then you compare what are your redundancies, what are your reserving, what's your ultimate loss ratio compared to the industry, and if you are, for example, reducing so-called insurance fraud
Sure.
by eliminating the conflict of interest, that will eventually have a positive effect on your loss ratio. That doesn't mean we, Lemonade, makes more money, because we don't.
Yep.
But what it does mean is that we give more and more money to charity.
Yeah, so there'd be pretty strong evidence there of some kind of difference in the claims trend against some benchmark that would show the consumers are behaving differently.
Exactly right.
Right. And early read on that, do you guys have a feel for that yet? Is it still too early to know?
It's too early to say something that's statistically significant,
Sure.
but the trend is in a good direction.
And
Oh, I'm sorry. There's also anecdotes. So it's not statistically significant, but it's worth talking about. In the year that we were operational, I was there. We got a dozen inquiries from claimants saying, "I found the thing that I thought I lost that you paid me for. I want to send back the money to you. How do I do that?"
really,
Now, it only happened a dozen times, and that's not
Still, it's more
statistically
than once.
significant.
Yeah.
But I was at AIG for 25 years. I cannot remember one instance, not one, where we got a phone call from a claimant saying, "I found the thing that I thought I lost. I want to send back the money. How do I do that?" So again, these little data points that makes you suspect that maybe things are different.
how about on distribution? Distribution for Lemonade is online. That's, although not completely new, it's existed for some years for some large personal lines carriers. It was like a Geico or a Progressive or something. When we're building the customer interaction process, what were in your minds there?
So that was another major decision that we made. So personal lines carriers go in one or two directions. They either have a huge insurance agency, either using independent agents or captive agents that are really still, for the most part, independents, meaning they're not W-2.
Yep.
Or they go direct, but they spend tons of money on advertising.
Yes.
Right? Billions of dollars, literally, on television. Well, we didn't want an independent, huge insurance agency and brokerage, because that would eat too much into the 25%, and we didn't want to charge more than 25%. And at the same time, we didn't have billions of dollars to spend on advertising. So a saying that was very big back then when we were thinking about these issues was, if you're going to challenge Bobby Fischer to a game, make sure it's not chess. So if we're going to challenge Geico and Allstate and Progressive to the game of personal lines, we have to do something differently.
Don't buy a Super Bowl ad.
Don't buy a Super Bowl ad. And we must be doing something right, because now I'm seeing more and more Geico commercials about renters insurance featuring millennials. I don't think that's a coincidence. But we had to figure out a different way. And for us, that was blogging, SEO, social networking, and a distribution channel that was, yes, direct in the way that I just mentioned, but also what largely is called in the industry affiliate marketing. But we had different types of affiliates. So we had building owners, for example, that wanted to make the renter's insurance available to everyone in their building. So that was a type of affiliate marketing.
Yeah, how about so here's an economic theory, and let me know what you think of this, where distribution costs will get bid up to the price of the opportunity cost, the next marginal use of that fund. So in this example, buying a Google AdWord for auto insurance will eventually turn into 15%. It's calculated differently because you're obviously paying for the lead and not for the actual policy written. But eventually, the price will wind up being the same as an independent insurance agency because that's what it's worth for a company to actually get that distribution. Can distribution genuinely be cheaper? Or
yeah, it actually can.
Okay.
And again, that's sort of the brilliance of the people at Lemonade that were charged with this,
Yep.
which is if you buy the word insurance
Yep.
from Google, it's ridiculously expensive.
Some say the most expensive keywords Google sells.
Exactly.
Insurance. Yeah.
And, buying homeowners insurance,
Yeah.
buying renters insurance, that's all very, very expensive. But if you buy renters insurance for dogs in New York,
Okay. That one's not too expensive.
that's not too expensive.
Right.
So what you need to do is find out, and the folks that do this at Lemonade are brilliant, and I don't even understand it. I think I'm too old to really understand it. But I know the general concept, which is narrow the keywords to a particular situation that happens often enough in your target audience that it's a worthwhile group to go after. But it's not so large you end up having to use general words.
Right, okay. So you have to have this large portfolio of words you're monitoring prices on to try and find which ones are the ones that are most
And you do a
efficient now.
lot of A/B testing, and
Yeah.
you're literally changing this multiple times a day.
Yeah, that's amazing. I
It is amazing.
That's a business that one of the ways I like to think about this sometimes is people will ask or hypothesize in our business, the insurance business, when will Google move into insurance? And I would argue they're already there. They're selling the keywords. That's you think selling the customer interaction, that is maybe the most valuable part, or maybe not the most valuable part, but extremely valuable part of the whole distribution chain is actually accessing the customer. I don't think Google needs to do anything else.
Yeah, I know. I kind of agree. And the problem with Google going into insurance, and I'm not going to say I know enough about it to have a firm opinion on it, but I'm sure they're very concerned about cannibalization of their own business.
Right. Yeah. Their customers.
Right.
Folks like
you
Lemonade.
got to be very careful about that sort of thing.
So we're running out of time, but a couple more questions. One of them is just on another really important difference, I think, between a call it venture-backed startup and a traditional insurance startup or a traditional insurance company is the venture-backed part. And so I'm wondering if you have any reflections or thoughts on how venture capital might behave differently, might influence the management differently, or just have let's call it enable a different kind of culture in a firm versus who else, like a stock company or a mutual or something else. Are they different?
They are absolutely different.
Okay.
And prior to Lemonade, I didn't know anything about venture capitalists. I didn't know who they were. I didn't know how they thought. But I rapidly found out.
Yep.
And I remember one of the first things Sequoia said to us was, we expect you to make a lot of mistakes in the first 3 years. If you're not making mistakes, then you're not thinking out of the box enough.
Yeah.
And eventually we expect you to figure it out on at least a certain level. And then once you do that, grow tremendously. Traditional investors in insurance just don't think that way.
Yeah.
They like saying, okay, we want you have a model. You've tried this, right, for a few years. It works.
You have a track record.
Okay, you have a good track record. I want to buy a book of business here, right?
How many times
how many
have I heard this?
policyholders do you have?
Yeah.
Now, if I give you money, you'll get more, right? That's the issue. You want to go into some more states. I mean, it's nothing,
so conservative.
Nothing against Shark Tank, but it boggles my mind, right? Because this is dumb money. This is okay. You got this widget. You're trying in a couple of towns. You've been doing this now for a couple of years. You got a great ROI. You just want to grow, right? Oh, okay, good. I'll give you $1 million, and with my distribution channel, I'll get you all over. I mean, you don't have to be smart to do that.
No.
Right? You don't have to be smart to do that. So, of course, we were fortunate enough to have investors from insurance companies, investment arms of insurance companies that thought like venture capitalists. You know, XL Innovate being the first one, and then Allianz, SoftBank, and AXA, and many others. But at the beginning, it was Sequoia Capital, the guy who started 20% of the Nasdaq, and Aleph, who was led the C round for WeWorks. Mm-hmm. And it was a different type of investor than normally the insurance industry has.
Well, what do you think about the charge? And you'll probably have heard this before. It's all about pumping up the company and selling it, right? I mean, there's a cynical kind of view of venture capital that they're in it for the short term, and the policyholders are going to wind up with a problem when the company sells, and you have to raise your prices or change your methods or whatever it is.
Certainly some VCs are that way,
yeah,
right? And that's why you have to be very careful about who you take money from. Fortunately, Lemonade's VCs think of it as the long run.
Okay.
And they share a fundamental concept that many of us have, which is if you want to be successful, don't think about your exit strategy. There's so many people who say, well, when are you going to exit? How are you going to exit? And they say, well, you should think about this from day one. Nonsense, right? I'm a firm believer that you develop a product that is worthwhile, that people like, that's good, and exit will take care of itself.
Yeah. And what's unusual, too, about Lemonade is that your results are public, which is pretty not common for a venture-backed startup, right? So people can look up your Schedule P and they can say, oh, your combined ratio is this and that. I'm sure you've seen headlines, people saying all sorts of stuff about that. What do the venture capital guys think about that?
They knew the rules of the game.
Sure.
I remember my first conversation with Sequoia, and they said to me, Ty, why are you thinking of becoming part of this? You're running a successful consulting company. Why do you want to become part of a startup? And I said it's because of Daniel Schreiber and Shai Whittinger and their past record and what I think they could do. And then I said to Sequoia, let me turn that question around. You've never invested in an insurance company. You're going to have a whole bunch of money just sitting in a lockbox somewhere, no interest. It's going to be years before you know whether this is successful. Why do you want to do this? And they said, this is who we are. This is who we are. This is how we think. So you have to be very careful who you take your money from to make sure that your investors, whether they're venture capitalists or anyone else, shares your patience and your long-term vision.
I'm going to make a guess here that this is one of the more impactful and educational experiences of your life, I would think. And you're nodding your head. I'll let you react to that question. If you were, say, a younger person in this business and you wanted to be the next Ty Sagalow, you wanted to move into the insurtech business, you felt like this was an incredible place to go, what advice would you give such a person?
Well, first, to your own self, be true, right? Be yourself, everybody else is taken. So if you like thinking out of the box and you like being innovative, and if that is what turns you on and hopefully you're good at, then find an environment that fosters that. I was very fortunate. As a 23-year-old kid, I was having dinner with Hank Greenberg.
Really? What was that like? What was he like at dinner?
Same as he is now. We got into a huge argument about the criminal justice system in New York City.
Oh my goodness!
And
I imagine he's a formidable arguer.
At the end of the discussion, I figured this guy really hates me, but I don't care. And instead of that, he asked me to work for him. So make sure you're at the right culture if you're innovative. Continue to look at what you believe the world, should be. And follow your dream, and make sure you're surrounded by people who support you in that.
Why did you write the book?
I'm 61 years old, and you mentioned before about Lemonade and my history, and in many ways, my entire life in innovation led to Lemonade. It's the culmination of decades of being what I was being, which was this guy creating innovative things in the area of insurance. And I'm 61, so I forget things. So I first wrote everything down, and it took about a year. And I worked with some really, really great people who did the writing for me, so I wouldn't forget the stories. And then after I wrote the whole thing, a number of my friends said, this is pretty good.
Yeah,
And
they're good stories.
They're good stories, and they talk about innovation. They talk about startups. They're worth reading. So why don't you just go and publish it? So I did.
It's a great book, great looking book. It's got the artwork's great. I mean, you did a phenomenal job. So congratulations on that.
Thank you.
Where can listeners get the book?
All right. Well, you can get it it's available on Amazon.
Okay, well, that makes it easy.
It's available on BarnesandNoble.com. It's also available directly from the author at www.themakingoflemonadebook.com. And I should say that if you want to buy more than 10, you can get a discount by going directly to the publisher at outskirtspublishing.com.
My guest today is Ty Sagalow. Ty, thank you very much.
Thank you very much.